Well, thanks for tuning in to Alpha Muggles. All of you who've tuned in right now, and all of you will watch this over the course of the next few days. This is the show where we speak to some of the finest investing minds about what is their strategy for portfolio construction and how is it that they expect to generate alpha with the holdings that they have over the course of the next 12, 24, 36 months. Our guest today is the thoughtful investor, Mr. Basant Maheshwari. Basant, so good having you. Thanks much for joining in. Hope all is safe in Calcutta.
Yeah. Calcutta is fine.
Okay, touch wood. Mumbai too seems to be okay, much better than what it was before, I guess. But wondering if you reckon that portfolios would be fine over the course of the next 12, 24 months. And there would be, I'm guessing, a lot of global factors and local factors impacting this.
So, Neeraj, I think everything except the stock market is in a problem. And there's a reason why the stock market is doing what it is doing. Ultimately, it's about money chasing goods, whether it's inflation. So inflation in stock market parlance means stock prices going up. So assume they were not stocks, they were products, they were commodities. And you have too many people with too much cash buying commodities. What do we have? Inflation. So what we are encountering is an inflation in stock market prices. So I think we have covered all our sins, all our troubles, all our trauma, the worry, the pain, and the wounds with lots of dollar. And for me, if you ask me, I think the hope revolves 10,000 miles to the west than 2,000 miles to the west.
Interesting. Well, the last 30 years, the world has been in a stubbornly deflationary scenario, which shows that inflationary or deflationary pressures could last longer than what all of us want. What's your sense with this massive amount of liquidity generated? And, the reason why I also asked this question is, in the last 6 years, we've had enough conversations about how at every point of time in those years, the liquidity was much higher, and at some point of time it will be rolled back, only to see it only go higher due to combat one problem after another. So what happens over the course of the next 4 or 5 years to this liquidity and thereby to inflation?
So for the last 30 years, we saw the emergence of China. And China was the chief architect in exporting deflation all across the world. So if you produce something for $1, Chinese did it at 70 cents. They kept 7 cents for themselves and sold you at 77 cents. Right now, you might argue that China is in a problem. So you won't be buying from China. But sooner or later, economics like water finds its own level. I mean, how long can you ask people to be patriotic and not consume Chinese goods, whether it's Indians or Americans or Russians or Africans, whatever? I mean, we all live and die for money. It looks so capitalistic. It looks so, brutal for me to say this, but at the end of the day, who would work 10 hours a day for free? So who would pay $10 extra just because he thinks that he's a great patriot, whether it's American or Indian is another issue. About the liquidity aspect, it's about a person cycling hard. The moment you stop pedaling, you're going to fall. So you can cycle for the next 10 years. You can cycle for the next 20 years. I can be a great economist, write a thesis and say, the moment it stops, you will fall. So if there's a cyclist around, you say, the moment you stop pedaling, you're going to fall. Mark my words. He says, don't worry, mate. I'm not going to stop pedaling.
Yeah. So is it suffice to say that it's almost impossible to guesstimate as to when the music would stop? The Fed's meeting yesterday also.
No, it's very possible. It's very much possible, and I will say it will not stop. There are democracies. Every 4 years, he has to be re-elected. If the world were being ruled by Genghis Khan or maybe Alexander the Great or maybe the Roman emperors, then he would have said, it doesn't matter, shut it off. But every 4 years, there is democracy. So there's an election. Who would take the risk of getting order into the system? I think the order into the system would come from the West Coast in America. The kind of innovations they do, efficiency will blossom, technology will advance itself. And I think 20 years from now, will crude still sell at $40? I don't know. Nobody knows. Look at the way Tesla is going in America. So Tesla, I think, has 1 or 2% of the market. So 20 years from now, there will be 12 more Teslas and one big Tesla. And look at the concept they have. If you buy a Tesla car, there's no maintenance cost. Most car companies make money on maintenance. So I think innovation and technology are the only two pillars that can help us get over this financial pandemic. Otherwise, it's like the central bankers are wearing masks, the people are wearing masks, and we are all having a nice time. But we won't lift our masks, we won't put it away. So we're going to be okay.
Interesting. I'll tell you where my conundrum comes in. When I speak to a lot of old timers, people who've been around for like 30 years, let's say, yeah, and who've been molded in the value investing principles, so to say, they look at these P multiples with disbelief, and they can't digest the fact that why is it that stocks trade at these levels. And there's a new breed of managers who are saying that I need to move with the times, and because of these liquidity issues or liquidity support, this is the new normal. My question to you is, because you're saying that it's possible to predict that this will not stop, would you reckon these new valuation normals might stay for a really long time?
No, it's not normal. The yardstick has changed. From stock prices being slaves to earnings, stock prices are not slaves to market share. And people assume that at some point of time, you will just turn the screw a little harder and make all the money in the world. So I think that's the big game. So if I can get 60% of India's market in anything, I'm willing to go without profits for the first 9 years. In the 10th year, I'm going to make everything count.
Got it. Okay. So then let's try and translate this into how is it that you are building your portfolio? This is a very short thesis. I could go on and on, but we have a bunch of questions that we have to answer to, some of these at least. So let me try and ask you, whatever little I have known about you, you run a concentrated portfolio. It's almost like, if your portfolio has 50% of a stock, if that stock does well, you're home. Have you changed this construct in a post-COVID world?
No, first, we don't put 50% into a stock. I don't know.
No, I'm just randomly using numbers.
I know. Right. No, the thesis doesn't change. So it's like in cricketing parlance, if you have a Virender Sehwag, so whether it's a bouncy Perth wicket or a slow turner in, say, a Sydney, he's going to bat the same way. Because that's what's worked for him. Even for us, that's what worked for us. See, if you concentrate very hard, you automatically avoid the losers. Because if I give you a choice, okay, Neeraj, let's buy 3 infra companies. By the way, we don't own infra. L&T is one of them. Nagarjuna Construction is another. J Corp is third. And I don't know, let's take any other. So you would say, Nagarjuna Construction nahi lene ka hai, J Corp nahi lene ka hai, L&T lete hain. So suddenly, through concentration, which to the common optical eye appears a risky venture, to somebody who's been doing this for decades, it appears a great way to reduce and eliminate risk. So if I give you an option to pick up 5 banks in India, maybe an RBL or an Axis Bank or an ICICI or let's say an HDFC Bank, you'll say, wait a minute, one HDFC Bank is good enough for me. But if I give you an option to pick 5 banks, you'll pick all 5 of them and look at the CAGR in returns over the last 5 years. Concentrated portfolio doesn't mean buying the worst business in town. It means choosing the best. So if you're at a party and you don't go around a buffet table picking up everything that's on offer. You look at your spot, focus on it, go and pick it up. So if you like noodles with Manchurian, you fill up your plate with noodles with Manchurian, and that's you're home with that. So that is one way of expressing it. So concentration with low quality stocks is a perfect recipe for disaster. Concentration with high quality stocks is going to create volatile returns. But as long as you get home, you don't care about volatility too much.
That's a powerful thought. The count, or not the counter really, but just the cross question to that is, it would have probably worked beautifully wherein it was possible to predict what the business and the earnings and the market share could look like in a pre-COVID world when the uncertainty was slightly less. Is it possible to do the same with as much efficacy in a post-COVID world?
So I say this to everyone. I say buy stocks in a sense that if your company closes down, India will be in a problem. So we don't own airlines. So if you buy Indigo and assume that Indigo shuts down tomorrow, there are 200 more people worrying more about Indigo shutting down than you. So if you buy, let's say, a PVR and it shuts down, we don't own it, not recommended. So then it's going to change the industry. So if you're concentrating, you have to concentrate on companies that if they shut down, the entire country comes to a halt. So assume HDFC Bank shuts down, because the problem with concentration is not about making lesser or making more. The problem is about life and death, whether this company will survive or not. So you can't buy a debt-laden company when you are concentrating portfolios. You can't go and buy a company that is running 2:1 debt. So, for example, if you're concentrating portfolios and if you have your investments in, let's say, a Kingfisher Airlines or a Future Group or a Tata Steel, that is going to be a little difficult. But if you're concentrating and if you've got the cream on the top, then I think there is still some hope.
Okay, so some of the questions that people have asked kind of tune in with the answers. So I'm just trying to say this. Yara Saub is asking about your thoughts on how to generate stock ideas, or Rohit Garg has asked about how long is long term according to Basant sir, 5 years, 10 years, 15 years. So I'm marrying these questions. If you're indeed building up your portfolio, do you really build it with that long term a time frame, or do you kind of take it a year as it comes, or a month as it comes, or a quarter as it comes?
So there are two definitions of a long term. The long term for an investor like us is till we die. We're going to be into the stocks. The long term with the stock that we own is as long as it continues to deliver. So if a stock which I have bought with some thesis and the thesis changes in 1 week, I'm okay selling it next week. For me, it doesn't matter. But historical evidence has suggested that 6 to 8 years of a company's lifetime is the best period for you to make money. And let me give you an example. 1993 to 2000 Infosys, 1993 to 2000, let's say Wipro, whatever, 2002 to 2008, all the infra companies, all the real estate companies. 2009 to 2015, all the Page, the iShare Motor, the Sun Pharmas. So 6, 7, 8 years, that's it. If you have a long-term view, then you will pull the entire thing out. So for example, Page Industries, from 350 in 2009, it went to say 14,500 in 2015. And from 14,500 in 2015, it's still at 20,000. So anybody who's doing an 11-year analysis will take out a CAGR and tell you it's still delivered 30% plus CAGR. No, but it's like, I'm a complete vegetarian, but it's like catching hold of the meat and leaving the bones. So if you take the first 6, 7, 8 years of a company's growth period, you will have the meat with you. What is left over is the bones. But somebody will say, even with the bones, the chicken tastes good. So that's how you look at it.
Would you look at banks the same way or financials the same way? Because somehow the high quality financials, HDFC Bank, for example, has had not a 8-year run, but nearly a 15, 20-year run, right? And they continue to deliver that 10, 15, 20% CAGR. Some NBFCs might be in that space as well. So would financials be slightly differently viewed?
Over a period of 20 years, 30 years, HDFC Bank, I think for the first 6, 7 years was growing at 40%. Then it came down to 30. Then 30 became 28, 28 became 25, 25 became 22, 22 became 20. Now we say 16 to 18. So it's like age on a person. Everybody will age out. Everybody will die. So, but then the thing is, you have to catch these companies in their youthful years and then leave them as things attain maturity.
Yeah.
Plus, there is no need to catch hold of a company and keep it till the very end. It's like you have to be very opportunistic. It's not like choosing friends for a lifetime. It's like if you find somebody else, leave and go to that person.
Yeah. Okay, that's an interesting one. That's an interesting thought. A lot of questions, Basant, come around. This two key aspects. One, the number of traders or fresh people or new demat accounts that have opened up with the Zerodhas, the Upstocks, the ICICI Securities, and the way the mid caps and the small caps are flying around. What are your thoughts on these two subjects, and what if they mean anything for the markets per se?
I mean, basically, most fund managers like us, when we miss the rally, we pick out reasons. If you think the retail guy can take $100 billion company to $250 billion company, then I think it's more power to retail, and we should return all the money back, and we should ourselves give the money back to the retailers. Markets don't go up and down just because somebody is buying or selling. The absence of buying and the presence of selling gets the stock markets to fall. Similarly, the absence of selling pulls stock market prices up. So I think what you had during the COVID period was the absence of buying. There was so much of fear and negativity created, most of it unnecessarily, but that's another story for another day, as somebody would say. And what we had was the prices kept falling. At some point, the sellers got frustrated and they said, we've sold enough. We've got nothing more to sell. And I think the bottom of this market was made when Donald Trump came out and said, America is going to see 140,000 deaths, because at least the best of that was the humanity will survive. And humanity was in question before that. And everybody would spend 60 seconds on 2 Wikipedia pages of the Spanish flu. And everybody knew how the Spanish flu went, how the second wave came, how the third wave came, not realizing that during the era of 1919, 1920, there was no WhatsApp to tell people to mask yourself up. There was no awareness. There was no information flow. And I think most of us make the same mistake. We use 100-year-old theory to exist in today's world. And the 100-year-old theory doesn't work in today's world, because the world has changed, the thoughts have changed, the expectations have changed, and more importantly, the mindset also has changed.
Interesting. Okay. Speaking of changes, there are 2 changes, right? I mean, somehow everybody says that what the West is doing, what Silicon Valley is doing, what those tech giants are doing, nobody else is able to emulate. So would you reckon that the lion's share of the gains could actually be made there, or that is not a universal rule? And of course, I also want you to answer my previous question, which is about whether this start of this rally that we're seeing in mid caps and small caps, does it worry you?
No, I mean, see, markets will always move in cycles. Mid caps will go up. I mean, if you don't, for us, we don't think there is any logic in just buying a company because it is a small cap or a mid cap, unless it is the leader of that sector. If it's not a leader of that sector, the rally will always be short, it will be truncated, it will meet an abrupt end. If it is a leader in its space, then obviously you could be very sure that the rally is going to continue for the next 6, 7, 8 years. All the examples that I gave you, for example, Infosys, Wipro, L&T, Unitech, DLF, Page Industries, Eicher Motors, Sun Pharma, they were all leaders in their space, and they could exist and create revenue returns for their investors over the next 6, 7, 8 years. But most of the mid caps that come to you right now are there for 6 weeks or 8 weeks or 6 months or 9 months. I've not seen a mid cap make consistent returns from 2014 to 2020 or from 2015 to 2020. And if it makes consistent returns, Neeraj, it becomes a large cap. So would you sell your mid cap just because it's become a large cap and look for another mid cap? Because the biggest gains come when a stock becomes a mid cap from a small cap and becomes a large cap from a mid cap. So I think there are too many anomalies in this entire theory. About the second part, innovation coming in the West, I think that's where innovation will come from, because that's where people write checks for you to make losses. I mean, who would write a check to you if you say, I have a business plan where I want to make losses for the first 6 years. In the 7th year, I assume that I will have 25% of the market share. I don't think even your parents would write a check to you.
Yeah. I think we just had one telecom player doing it for himself, not that he got too many people and the people came in only after he showed some promise. But that's interesting. Okay. No, just one last question, and then I would want to talk about some specifics. What I was actually trying to get to is that does this whole, because it bothers a lot of people hear through articles, etc., that mid caps and small caps, when they start to fly, you got to be cautious. Or when so many retailers get into the investment stream without having knowledge, it is time to be cautious. Do you think so?
See, most markets stop off because of absence of liquidity. So I think more than the earnings, more than the mid cap, small cap mania, of course it's worrying. But if there is no absence of liquidity, I don't think markets are going to top off anytime soon. You know what Jeremy Powell said yesterday. I mean, He was saying that, see, I'm here writing a check to you till inflation hits 2%. I don't think inflation is going to hit 2%, because inflation is not just about more money chasing goods. It's also about the demand side. So I'd be greatly happy and enthused if inflation hits 2.5%, because that would mean there is some demand coming at the end of the game. I don't think there is this liquidity which is going to stop anytime soon. So you cannot look at the entire market with one angle. For example, I can give you a theory that if a company delivers earnings, the stock price will go up. But companies didn't deliver lesser earnings for March than they did for June, but still stock prices went 50%, 60%, 70% down. They recovered back. So earnings will support you if you have a 3-year view. If you have a 3-month view, it's to liquidity. If you have a 3-hour view, it's on sentiments and emotions.
Interesting. Well, that could be the headline for the show when we do it, a story. Okay, let me ask you about the portfolio construct, Basant. You mentioned that the way the process of picking companies, focusing on market leaders, etc., has not changed. Have the themes changed at all for Basant Maheshwari before March, post June?
Yeah, to some extent they have, but we're still betting hard on financials. We think financials is the way to go. See, if you are assuming that financials won't survive, then India has to become the India of 1997 to 2000, where only 3 sectors used to do well. One was FMCG, the other was IT, and the third was pharma. So basically, when these 3 sectors do well, you assume that the domestic economy is gone for a toss. So that time globally, we had the TMT boom. So if you assume that autos would do well, and you assume that no NBFC would do well, there is some gap in the reasoning power. Autos cannot do well without NBFC doing well. So 2 months back, cement companies were going up, but banks and financials were not going up. So maybe the country was assuming everybody is going to construct his own house with his own money, or these companies will sooner or later come back to the fore. So you have to connect something that is doing well right now to assume what will do well 2, 3, 4 months down the line. So looking at all that, I think the biggest rally in a post-COVID, post-vaccine, post-pandemic environment would be in the financials. And if you assume there'll be no vaccine, then I think whether you own stocks or you don't own stocks, how does it matter? You're going to be dead any which way.
Okay. Yeah, that's true. Well, then I'm squeezing in a couple of questions since you brought out financials, and then I'll ask about some of the others. Arvind Ramachandra, for example, is asking about what's the future of standalone housing finance companies, because you used to be bullish on these a few years back. Or Prashant Agarwal is asking whether Basant sir, it'll be great to hear your view on NBFCs. You partly answered the NBFC view. If you want to elaborate that a bit more, and then on housing finance.
So 2 things. Housing finance, because the RBI has changed the rules, the number of the capital adequacy norms have been changed. So it's not going to be so easy for housing right now, if you ask me, because the amount of leverage you could do with your own funds, that has gone down. And more or less, I think the entire business of picking up a home on mortgage, people would just defer it for a while. But that's for the next 1 year. If you have a 5-year, 7-year, 10-year view, we are going to go back to the same things. I mean, when you join a weight loss program, you diet yourself for 3 months, 4 months. You can't do it for 30 years. So that's one way of looking at it. About the NBFCs, we've just bulldozed these stocks thinking about the COVID provision. I think what's missing in the analyst mindset is, what if there is a write back? So if I'm a company and I've taken, say, a 200 rupee provision, what if I recover back 50 rupees from the client? Because provision doesn't mean a bad debt. Yeah. It just means that I'm a little astute, I'm a little forthcoming, I'm a little conservative, and this is the provisions that I've taken. So I think the stock price says one of these stocks will get a ride back. And let's see and let's wait.
Any distinction between the lending and the non-lending financials?
I mean, the lending business will do well when the economy recovers. The non-lending, see, Neeraj, ultimately it's about how much money has changed. So if I had a mandate to keep financials, I would have sold the lending side and I would have bought the non-lending side, thinking that people would go and insure themselves more. So I read this in some book, I don't remember. They said that if you sell terrorist insurance coverage just before you take on a flight and after you've taken a boarding pass, you would get more conversions than if you would do calling them on a normal evening. So it's just about that. So COVID is gone. So I've got myself insured, presumably over the last 3 months, 4 months. This doesn't mean insurance companies won't do well. They're one of the best things to own for life. But just to create an entire thesis around buying a non-lending business, I mean, that's not going to help you too much. See, with the market, as it changes so fast that if you keep changing with the market, you have to keep changing. It's like you cannot change once or twice and then say, I've done my change, let the market do what it wants to. But then it's very difficult. But if you ask me, the non-lending business is great. You're going to make a lot of money from there. But right now, I think more money is to be made on the lending side.
Sorry, can I ask you, are you doing those changes so much in a portfolio like yours, wherein there is so much concentration as well? Because the market is changing very fast, as we see. So are you Is the market forcing your hand to make changes even if you didn't want to, for example?
So one change we made was we bought liquor companies because we thought the entire country is going to a complete standstill till November. And we knew financials won't be able to survive if there is a second mortgage, third mortgage. So you go and buy liquor companies. Don't look at financials. Even though we want, even if somebody would have whispered into our ear that the company isn't going into a lockdown till November, we would have bought the financials any which ways. But if the entire country was pushed into a lockdown till November, let's assume, I think even HDFC Bank would have had a problem paying its bills. So we bought a liquor company, and in 1 week, we knew that the COVID numbers are coming down, and the government shifted the narrative from lockdown to unlock one. So when you shift the narrative, you have to move ahead. And of course, we bought it and we sold it in about 1 week. But then that's how you have to move. But then we don't need 5 stocks in a year. For us, 1 or 2 stocks in a year are enough. So that's how we changed it. And if you ask me, I think technology, internet, and rural India are the additional themes apart from the financials that should do very well over the next 2-3 years.
Okay. Before I quiz you on those, let me ask you one more counter, Basant. And if indeed technology is going to do well, tech-enabled businesses are going to do well, what about those businesses which are competing against them? Like, for example, every retail business is now going to be competing against Amazon, Flipkart, JioMart, which are all tech-enabled. What happens there? Every multiplex business or entertainment business is going to compete against the Hotstars, Amazon Primes, and Netflixes in a big way because movies are now getting released. What happens to all of those businesses? You used to own a couple of them, I believe.
No, yes, we used to own DMart. We don't own it now because we found better options somewhere else.
Sorry, did I hear you say that you used to own DMart?
Yeah. We've exited DMart in this entire thing because we found better options elsewhere. And, it's not economically viable to deliver a 50 kg bag of, let's say, rice or atta to your house. It's not economically viable because the courier costs are too much to it. So how does this change? So then you've got the PE-funded guys who are going to bleed over the next 2-3 years. There's going to be a problem because people just, even though you sell cheap, they wouldn't get into your store. So DMart is, again, as a 10-year view, it's great. It's going to exist. It's going to do very well. But we found better options for the next 1 year, 1.5 years, and that's why we changed. But ultimately, technology is going to take over. It's about habit. I never used to order so much on Amazon, but over the last 3 months, it's even if you need a clipper for your nails, you just go to Amazon and you order it, and you get the best thing in your house delivered 3-4 days. So who's going to take all that trouble? I think once these habits change, it actually disturbs and disrupts businesses. But change is always small. Change is not 50% a year unless it's a new product altogether. So there's a landline and there's a mobile phone. So I pick up my phone and I go out the moment I want to. That change is forceful. That change increases your productivity. That change becomes a habit. So change of going into a store and picking up a packet of biscuits or ordering it from Amazon, that change is discretionary. It's not that if you don't order from Amazon, you won't get biscuits at all in life. So that change is small. That change happens year on year, year on year, year on year. It takes 10, 15, 20 years. And by the time it changes, I think unless the government stops selling combustion engines, I don't know, electric car is going to change the world over the next 3 years. But the change is small, yet powerful. So we have to notice change, which are really effective and powerful and disruptive, and change which is really discretionary. So when it's discretionary, it's like you get enough time to move out.
Wow. Somebody was making this point that the government, Indian government at least, has much larger problems in terms of road connectivity, etc., as compared to making electric fuel stations. So don't bother about electric cars too much. I don't know what your thoughts are there.
So I don't think electric cars are going to come to India in a big way, at least over the next 10 years. Where do you get the charging station? Unless you assume that the BPCL and the HPCLs are going to transform themselves into electric charging stations. Still, I think, and because those cars are not cheap. You can't sell an electric car at 3 lakhs, but I still can't pick up a old Maruti at 2 lakhs, 3 lakhs, whatever. So I think it's also about the price point. So basically, if you look at it, I think the top end segment is going to change. The BMWs and the Mercedes and all the Audis, they're going to do the electric car way, but the Maruti is still going to run the roads.
Okay, very interesting. I'll ask a couple of other questions. So somebody's, of course, we've already spoken, Drumil, about the slicing and dicing in the financials. I won't stick to financials cross, but I'm just trying to ask other questions. So Basant, Nitesh Malviya has this question. He's saying that taking a cue from your book, following sectors which are hitting 52-week highs regularly, does it mean that the next bull run would be led by APIs, pharma, and chemical companies? Your thoughts on those?
Just hitting 52-week highs aren't enough. There has to be sustained secular growth. So if you can pick up a company and you say there will be sustained secular growth over the next 5 years, at least 20% plus on the top line, I think it's a great stock to own. But then if you cannot make up your mind whether you will get 3 to 5 years of sustained top line growth, I think you should think twice before putting money just because the stock has hit all-time high. All-time high doesn't mean you go and buy the stock. It means pay a little more attention than what you would have done normally.
Wouldn't if a good business is consistently hitting highs, wouldn't it mean that no, it is not necessarily overvalued, but they are doing something right within the business for which the market likes it?
All-time high tells you the market knows more than what you do. And sometimes the market might get it wrong also. Market might be assuming that it's going to grow for the next 5 years. It doesn't grow for 5 years. And that's where an investor's intelligence comes to the fore. He might say, I don't think this business is going to grow 25% top line for the next 5 years. So, and plus I have realized and understood that things that happen because of government restrictions don't take you too far in life. You remember 3 years back, we had those graphite boom where the HEGs and the graphite electrode, they used to, I mean, any day you used to open this TV, they used to be up 10%, 5%. It seems to be a 7 up, 7 down game at that time. But I mean, it's good as long as you can call the number. But if you can't call the number, then that's a problem.
Yeah, it was a bit like J Corp in 2007, isn't it? Or just wake up every morning and it is be locked on an upper circuit. Okay. Do you make hedges to your portfolio? It's a question I wanted to ask you. And somebody else is asking this too, of course, by the way. Sanjay Mittal, I think, is asking.
Hedges cost money. So if you hedge yourself, you'll be fine because when the markets fall, you will be protected. But hedges don't come cheap. So if you hedge yourself for say 5 years in a row, you would have made more money by not hedging yourself for those 5 years. But sometimes we do look at some data coming at you. For example, the VIX data, that's one of the most important and powerful aspects. Fundamentalists won't talk about it. They get embarrassed speaking about it because then it would appear, अच्छा, VIX भी देखते हो? हाँ भाई देखते हैं, पैसा लगा है तो सब कुछ देखते हैं, क्यों नहीं देखेंगे? So now the point is, Indian VIX, when it went past 30, was the time to just say, I've had enough of it, I want to get out of it. And we knew something was going wrong. We reduced a lot of leverage, but didn't really act on that. And strangely, these are indications that come to you after the event has happened. So after this event, we've learned a lot of lessons. I hope we don't get a chance to implement those lessons learned.
Okay, interesting. Just wondering, is it also, I mean, if you constantly try, I'm just thinking out loud or asking you that if you constantly try to, think of hedging yourself, aside of the money cost, is it also a mental exercise that you're constantly telling yourself that you're not sure about your bet and therefore you are hedging? And if you were sure, then you don't need to hedge because you've done your study enough and you don't have a 1 hour view or a 3 hour view. You actually have a slightly medium term view.
See, hedges should always be happening on leverage. So if you have a capital of say 100 rupees and your market position is 400 rupees, then you have to hedge yourself. But if you have a capital of 100 and that's what you're betting on, you can't go to zero. So hedges have to come with leverage. See, it's like buying an insurance policy. So most of us buy insurance. So, but then if you pay too much premium for your insurance policy, if you buy an insurance for everything, for example, if this video link were to go off suddenly right now, I have an insurance policy that's going to give you 2,000 rupees and 2,000 to me also. everything costs money. Nothing's free in this world. So you have to understand what are you in it for. Because if you hedge yourself consistently, I think hedges, we worked it out, it would take away 30 to 40% of your gains. Why not buy simple companies like a Nestle or a Britannia rather than get into the complicated business of hedging yourself so much? Yes, but if you are hedging yourself and if you think that your hedges will make money, for example, if I am March and I know this COVID is happening, so I would go long on FMCG and I would go short on financials. So if I do all that, then you need hindsight information. That is not exactly hedging, but that is one way of taking two diametrically opposite views. I've never seen anybody do that consistently over longer periods of time.
But about the mental piece, I mean, is it kind of self-defeating that you constantly think of hedging?
No, I think you are mentally not at peace. That's why you're going in for hedging. So, and if you hedge, obviously it gives you mental peace, but then the returns are not worth all that effort. Okay. I think hedging it's not for retailers, if you ask me. First, make enough money that you can't afford to lose, then think about hedging.
Fair call. Okay, Veer is asking a question. In your book, The Thoughtful Investor, you say that in a recovery, after auto companies begin recovering, banks follow. After banks, cyclicals follow. Which industries in particular do you mean when we talk about cyclicals? First, do you believe cyclicals will follow, or is it some time away?
No, cyclicals won't follow because the entire market has changed right now. I think cyclicals will follow and growth will follow. And growth will follow when you see the Federal Reserve say that we are going to raise rates. So I don't think even the Fed assumes that growth is going to come back anytime in the world, and they're not going to raise rates. So you might make out a case, we don't own it. You might make out a case and say, let's buy a Cummins or let's buy this and that. It's giving me a 4% dividend yield. So those stocks are okay, but I don't think there is any huge runway for cyclical. See, cyclicals go up when existing capacities get utilized. When existing capacities don't get utilized, people don't invest in capex. The last 2 years, I've not seen Indian companies invest in capex. I've not seen anyone say that India goes around putting up a 10,000 crore power plant. Nobody does that these days. So I think it's a little difficult right now.
Okay. Just a follow-up to an earlier point that you made, Basant, and that is how you alluded to how in 1997 to 2000, TMT, FMCG, pharma did well. When I look at what businesses are seeing higher consumption, TMT is right up there. Pharma is right up there because of the fear or otherwise, but it's right up there. And staples, frankly, or FMCG has done well. So is there a bit of a loose correlation there or no, not quite?
Yeah, there is because the globe had an economic problem in 2008, in 1997, in 2020. Reasons were different. So in 1997, you had these Asian tigers where the greatest of all minds, the guy who actually invented the Black-Scholes formula, went bankrupt. And everybody knows about it, long-term capital management. Because who knew about hedges more than the guy who's invented the Black-Scholes formula? He went out of business because there was complete absence of liquidity. 2008, same thing, but 2008 and 1997 were economic problems. 2020 was man-made, God-made, I don't know who made it, but there was a problem. And this problem was different. This problem was locking all the buyers in one house and locking all the sellers in another house and saying, you guys are not going to meet for the next 2 months. As we set them free, we would know. So the biggest problem now is if recovery comes through, you would never know whether it's pent-up demand, whether it's Fed liquidity, whether it's the leader taking away market share. And by the time you know it, we would have reached some sort of a top. So I think it's very difficult to actually become an economist and an investor because economists by nature are pessimists and investors by nature are optimists. So I read all about economics, but I have my own economic theory. कि देखा जाएगा क्या होता है. So that's how it is.
Okay, interesting. So, okay, a couple of other things, a couple of questions. Arjun Badola is asking, actually, Arjun, I'll take your question in a bit. First, since we're on the topic of themes, etc., Basant, you mentioned that aside of financials, a few other themes you reckon would actually do well over the course of the next 2, 3, 5 year period. where is your strongest conviction and why? Thematic, only thematic.
Technology.
Okay.
Anything that can change the world, anything that starts disrupting, anything that starts pushing the normal guy out and says, I mean, because technology is two things. So, for example, not that we have identified anything specific being the operative word on that. If I can have a technology platform where I get all the depositors and all the borrowers together, do I make a threat to HDFC Bank tomorrow? That's the key question. And I'll tell you why. Because HDFC Bank still has to pay up rental. And by doing this, if I get all the depositors and all the borrowers on one table, I cut down operating costs immediately. I cut down the cost of the salesman who goes around pushing my product to the new prospective customer every morning. And if I can pass that on, say 2 percentage points, I suddenly give loans at 2 percentage points lesser than the market rate and give my depositors maybe a little bit more than what they would have otherwise got. So I think this is just one example, a tremendous amount of changes waiting to happen. All they need is execution. And if there is somebody who can execute all of that well, I think over the next 18 months, the biggest money would be made in these kind of companies. So that is what we feel.
Interesting. But in the financial model, it hasn't quite happened globally anywhere, right? I mean, because even in large tech-enabled countries, and some of these models have been launched, but have you seen evidence of the
Alibaba.
Incumbents getting, okay.
Alibaba.
China, well, sure. China, I agree, but no, non-China, Europe, etc. I mean,
India is going the China way.
Okay.
You are promoting local people. Atmanirbhar hai hum. So bahar wale aa nahi payenge shayad. So that's how it is.
Okay, that's interesting. Okay, couple of questions and interesting ones, Basant. So Arjun Badola is asking that, I mean, he's saying that catching the company in the earlier period is great, but how? Because while you can't give an answer, is there a mental model that people can build to try and understand how to catch companies earlier?
Anything that your Excel tells you to do is not worth doing. These things will come to you on their own. You will have to take a leap of faith and you will have to assume what's going to happen. And I think the biggest thing that we miss is we pay too much attention on current profits and too less on market share. If you found a company that's consistently taking away market share, at some point of time, it's like the company being in the thick of things and it just say, hey guys, why don't you all pay me 20% more from next month or next week? So most analysts wouldn't predict that because it hasn't happened. Most fund managers wouldn't want to bet on that because tomorrow the clients might say, how did you think so fancy? So, but the real money is to be made there. So if you found a company that has the power to stand up and say, please pay us 50% more by next month, and their customers will start paying them, I think that's one way to look at it.
Interesting. So I'm guessing there is a bit of a shift in a way a lot of people are thinking, and somebody's quoted you. I think this is Rohit Goel, who's saying that Basant used to believe that elephants cannot dance and used to mostly look at small caps for big growth. Has it changed with the big companies growing and taking market share? I think you part answered this already. Do you want to elaborate a bit here?
Yes, there is a dancing elephant, and I love that stock. I wish we could put as much as we want into that. It's called Tesla. I think it's sort of another world. I mean, 25% of S&P weightage is controlled by the FANG stocks right now. So you could say, I mean, look at the growth Amazon had. I mean, it's still growing at 18-20%. And Neeraj, there's one part to grow at 20%. And there's one part for you to grow sales at 20% and profits grow at 30, 40, 50%. Because in a tech-enabled business, every incremental money has a disproportionately larger flow to the bottom line. It's not like a cement company where to manufacture one extra bag of cement, you need the same amount of limestone, the same amount of gypsum, the same amount of coal, and the same amount of labor. So every increment, for example, if BloombergQuint, if 10 people are watching this program and suddenly you have 200 people watching the program, I don't think your operating cost is going to go up. So that's how it is.
Yeah, well, agreed. Okay, so, just on that point, because you mentioned Tesla, I just wanted to probe this a bit. And different people, of course, think differently. But in the last Alpha Moguls show with Prashant Khemka, Prashant was saying that Tesla's robust rise is not unnatural, and it is pointing towards something that the market may not be quite thinking out like. It could be pointing towards the demise of big oil, the demise of certain other industries, or the acceptance of a technology which will become really big with time. What's your sense about this? Because I can still correlate, right? People can still correlate some business growth, some earnings growth to Amazon, to Facebook, etc. Most people find it difficult to correlate it with Tesla. Do you have any thoughts here?
Tesla is great for a country with a market cap of $60,000, but for us, $2,000, we still have time to worry. Because the minimum price point at which Tesla sells its cars, I don't think they're going to get too many buyers here. So like I said, in India, we might have all these fancy big names change to electric, and they've already started doing that. An Audi, a Mercedes, or a BMW, or a Land Rover, or Range Rover, whatever, Jaguar, they would have to change. Because nobody would want to buy a 70, 80 lakh car right now thinking, let's use it for 4 years, because people would put that off because you're still worried about how electric cars would come through. But I think if you're selling Wagonrs, or if you're selling, let's say, an Alto or whatever, I don't think that's too much to worry about.
Okay, Basant, aside of tech-enabled disruptors, are there themes that have taken shape and form in India? I mean, just to kind of illustrate my question properly, I thought back-end manufacturing, for example, becomes a big theme simply because of this whole Make in India, etc., etc., etc. I'm wondering if you believe, well, of course, if you have thoughts, then they're there. And otherwise, aside of being tech-enabled, is there something else that has become a pronounced theme?
See, Make in India right now, I think, is more in the mind than on the ground. We've had so many, pushes. Startup India, Stand Up India, Digital India, Grow Up India, Cool Down India, but they don't seem to actually gather any momentum. So you can encourage Make in India by increasing import duties. You can do all that for the next 2, 3, 4, 5, 6 months, but ultimately, economics will take over. Would you be willing to buy a phone for 42,000 when, had you had this imported from China, you would have had to pay only 35,000? I don't know how many people would do it consistently. Hi, when there is a skirmish at the border, you all get patriotic. Over a period of time, when there's shortage on the 25th of every month, we all think, ki bhai thoda paisa bacha ke chalao. So these things don't work in the long run. But for Make in India, it's not that the government, there's so many things to do. Land acquisition is one, labor, the mindset, the skill set. I've read stories about how hard the workers pay. I think in America, most of the Chinese students top their classes all the time. So they're really hardworking. So you can push them just because they've got a very unpredictable guy at the top. But then economics to be overlooked by patriotism and something else, it doesn't happen over longer periods of time. It might happen for a month or two, for a quarter, 2 quarter, 3 quarter. The moment a vaccine is identified. So what if there is no Trump after November? By the way, I don't think Trump is going away. But what if there is no Trump and there's a Biden? What if they just patch up with the Chinese and say, okay, guys, you got it wrong and we understand what happened, but you should have been a little more careful. The entire theory changes. So I think you have to be with companies where you don't have to depend on your leaders to actually fight with somebody, or your leaders to make up with somebody. Companies have to exist in a free market environment, and that's what free market is all about. So I think all that theory is coming, but how long it sustains, I don't know.
Okay, well, that's an interesting thought too. Basant, my final question, and that is, or maybe the second last question, but I'm just asking, for somebody with a small non-leveraged portfolio, digesting falls might be relatively easy. Now, I'm not saying you have leverage, but I'm just asking you because your portfolio sizes would be larger, plus you manage large portfolios for other people too. How difficult was it to withstand the constant noise and the price damage that we saw until in March and April? How difficult?
Let me give you an anecdote. It was like you just came out of an operation theater after a bypass surgery. You knew you would be fine in 3 months, but still you had to spend those 3 months. And that's the best way which describes us. And the bypass surgery probably was not needed, but the doctor just pushed you in on the side of caution, maybe you would say. And that is the best way to explain this, because I've always maintained, and I went on record to say in 60 days, you won't get the prices again. So I've always maintained this was not called for, but we had this process and you had to survive 60 days. So surviving 60 days was the toughest part. It was like, this too shall pass. Nazi camp mein jo allied soldier ko pakad ke rakhte the. So it was like that. So I always used to say in November, the prices would be something else. And I still say that. In November, we would not know what the market would do. So let's see how it turns out.
Okay. And the final question, which is probably the question on most people's mind, which is, do people, I mean, and you kind of mentioned that you will buy companies which are market leaders in that sense, but even there, what kind of role would valuations play in your decision-making process? I'm guessing you don't look at PE right now, but what kind of role what kind of valuations would play what kind of role?
Because Neeraj, I have not been able to figure out who decides value. Who decides margin of safety? Because the basic theory of value and margin of safety changes from person to person. So I've got people who would say dividend yield, your purchase price, and somebody would say a little more learned, he would say, do a DCF. Okay, so who decides the cost of capital? Most DCF exercises are done like how we used to solve algebra problems in high school. Answer nahi aata tha, we used to flip the page over, look at the answer and see whether we can get that answer or not. So if you tell a guy to do a DCF without focusing anything on the target price, I think his target price would either be 50% above the market price or 50% lower. Then he would say, let me change my WACC. Let me change the cash flows. So I think, like I said, anything that you can do in an Excel is mostly not worth doing, because Excel doesn't capture if your company can increase prices by 10% next month, if your company can increase market share by 10% next month, if your company does nothing, but the competitors die away next month. So that's how it is.
Well, this was insightful and it was lovely. So I thank you for joining us today on this session of Alpha Moguls. Basant, this was the first of the live webinar Alpha Moguls that we've done, and it was a real pleasure having you. So thank you for sparing the time. Thank you. And viewers, all of you in large numbers right now, and of course, we'll watch later on. Thanks so much for tuning in to this session of Alpha Moguls.